Welcome to this explainer. We're diving into a truly bizarre paradox today. In almost every single aspect of life, working harder and hustling gets you better results, right? But what if building wealth is the one job on earth where effort is literally a penalty, where the more you touch your money, the smaller it actually gets? Well, today, we're breaking down a really fascinating analysis from Nick Invests to uncover exactly why the easiest, laziest way to get rich, the person doing absolutely nothing, is quietly lapping the person doing everything. Okay, let's set the stage here with two archetypes, Danny and Priya. They both make the exact same salary, and they both put away the exact same amount, $500 a month. Now, Danny is that guy at the office. You know him. He's refreshing a trading app through a cracked phone screen at every single red light. He's actively managing his money and has made something like 200 trades this year. Priya, on the other hand, she works in accounting, made exactly one trade back in 2019, completely lost her password, and literally never logged in again. So here's the central mystery of this whole explainer. Guess which one is actually winning? The math doesn't lie. The data says Priya's extreme laziness is absolutely crushing Danny's constant hustle. Section 1. The effort penalty. Why trying hard fails. I know it sounds completely counterintuitive to say that trying hard makes you poor, but let's just look at the professionals for a second. There's this shocking statistic from the Spover report, which is basically the official scoreboard published by the people who run the S&P 500, and it shows that over the 15 years ending in 2024, almost 90% of professional fund managers lost to a simple index fund. Just think about that. These are people with Bloomberg terminals, huge teams of analysts, massive salaries. Their entire job is to beat the market, and almost 9 out of 10 of them lost to a completely hands-off strategy that essentially just buys everything and goes to sleep. This brings up an incredible story from the 1980s involving the legendary manager Peter Lynch. His Fidelity fund was an absolute powerhouse, averaging an absurd 29% return a year for about 13 years. But here is the ultimate punchline. Fidelity later went back, looked at the data, and found that the average investor in that exact same brilliant fund actually lost money. How is that even possible? Well, human beings just can't stop handling things. They bought in when the fund was up because they were super excited, and they sold when it dipped because they were terrified. It's just like a bar of soap. The more they handle their investments, the smaller their wealth got. And we can actually put an exact number on the cost of all this handling. A firm called Dalbar studies what humans actually earn in the real world after all their clever little moves. Over the 20 years ending in 2024, the market returned about 10.3% a year. But the average investor, they only captured about 9.25%. That gap is a little over 1% a year. Now, it sounds tiny, right? But compounded over 2 decades, it means investors paid a fifth of their potential wealth just for the privilege of doing stuff, which mostly just meant trying to time their entries and exits. Market timing feels smart, for sure. It feels super responsible to try to get out before a crash and jump back in before a recovery. But the data proves it is absolute financial poison. We're going to do a really fast sequence right now to prove this, looking at just 10 single days out of roughly 5,000 trading days between 2003 and 2022. If you had taken $10,000 and just left it fully invested for those 20 years, completely ignored it, you'd end up with roughly $65,000. But imagine you tried to be clever. You traded in and out, and in doing so, you missed just the 10 best days in the market out of those 5,000. Your $65,000 collapses to under $30,000. Literally missing just 10 days out of 20 whole years cuts your money by more than half. Now, you might be thinking, okay, simple. I'll just avoid the bad days and keep the good ones. Well, here is the cosmic joke of the stock market. You can't, because they are neighbors. 7 of the 10 best days over that entire stretch happened within 2 weeks of the 10 worst days, usually right after a massive crash. The market's biggest gifts are hidden inside its absolute scariest moments. If you sell in terror, you pretty much guarantee that you miss the bounce. The human brain is just a terrible market timing machine. Section 2. Building the lazy machine. The simple steps to actually pull this off. So this right here is Priya's entire strategy. 3 incredibly simple steps. First, grab the employer 401k match. Second, buy a target date fund. Third, physically forget the password. It's a system that requires, 3 or 4 good decisions up front, and then literally 0 ongoing effort for the next 30 years. Let's break down step 1, which honestly is so good it feels like a cheat code. If your employer offers a 401k match, they are physically trying to hand you free money. A typical match is often 50 cents on every dollar you contribute, up to 6% of your pay. That is an instant, guaranteed 50% return on your money before it is even invested in anything. No stock on earth reliably does that. Yet, shockingly, 1 in 4 American workers just walks right past this free cash, leaving roughly $1,300 a year on the table. Okay, so once you grab that free money, it needs somewhere to land. Enter the Total Market Index Fund or the Target Date Fund. A target date fund automatically owns a bit of everything, and it slowly shifts to safer investments as you age. It rebalances itself, and the data on this is spectacular. In a recent measured year, only 1% of automatic target date fund investors made a single trade. Think about that. 99 out of 100 just let it ride. This is exactly where laziness becomes a genuine superpower. You are actively being rewarded for your absolute indifference. Section 3. The Silent Wealth Killers. The invisible dreams you have to watch out for. First, we have to respect the absolute engine of wealth, which is compounding time. If you invest that $500 a month and earn historical market averages, in about 30 years, you are sitting on roughly $987,000, almost a cool $1 million for doing absolutely nothing. But here is the silent killer: waiting. If you wait 10 years to start, it doesn't just cost you 10 years of deposits. No, it costs you half your final number. Why? Because that decade you skipped was exactly when compounding was finally going to do the heavy lifting for you. And the second silent killer? Fees. The legendary investor John Bogle called this the tyranny of compounding costs. Check this out. If a plain index fund charges 3 cents per $100, but Danny's actively managed, hand-picked fund charges 60 cents per $100, Danny is paying 20 times as much in fees. He is functionally paying a premium price for a professional to make his portfolio grow slower. By choosing cheap and boring, Priya wins twice. Next up, you've got to protect your money from the tax collector by putting it in the right containers. For 2026, the limits are actually up. You can put up to $24,500 into a 401k and up to $7,500 into an IRA. These accounts let your money grow without being taxed every single year. There's also the HSA, which is basically a financial cheat code. It's tax-free going in, tax-free going, and tax-free coming out for medical costs. Now, don't stress. You don't have to max all of these out to win. You just have to know they exist and feed them consistently. So you might be asking, does this boring machine actually produce rich people in the real world? Yes, it absolutely does. Fidelity tracks retirement plans that have crossed the $1 million mark, and there are over 650,000 of them just in 401ks. And who are these people? Well, the average one is 59 years old and has been in the exact same plan for 26 years. They aren't day traders, they aren't market timing geniuses, they're literally just ordinary people who made boring deposits into the same account every single paycheck for decades. Priya isn't some different species, she's just an earlier chapter of this exact same story. Section 4. The hard truth about simple. So, why isn't everyone rich? To really understand this, we need to shift away from that whole hustle bro mentality for a minute. The first hurdle is just a harsh reality check. This entire lazy strategy requires positive cash flow. You need to actually have money left over to invest. And right now, nearly 4 out of 10 adults couldn't cover a surprise $400 expense with cash. Among households earning under $30,000, only about 13% own any retirement account at all. So lacking the surplus cash to invest isn't a personal failing. It's the brutal reality of wages, rent, and childcare. The lazy path to wealth is absolutely real, but we have to acknowledge it requires the privilege of having a surplus in the very first place. And hey, even if you do have the surplus, there are future risks you gotta navigate. Big forecasters like Vanguard and Goldman Sachs are quietly warning that US stocks might return a bit less over the next decade. Not zero, just less, which means we might need to save a bit more to hit our goals. There's also something called sequence of returns risk. This is just the danger of a really nasty market crash hitting exactly when you retire and start pulling your money out. But remember that target date fund we talked about? That's exactly why it slowly shifts to safer investments as you age. The lazy machine is actually designed to protect you from this specific type of bad luck. But here is the absolute hardest truth of all, and it perfectly captures why people like Danny exist. Simple is not the same as easy. The mathematical plan, it literally fits on an index card. But the psychological reality, it's 2 a.m., the market is down 34%. Your account just bled out $40,000 in 3 weeks. The app is glowing in the dark, the headlines are screaming that the world is ending, and your thumb is hovering right over that sell all button. The entire success of this strategy rests entirely on whether you can put the phone face down and just go to sleep. We've been sold this idea that wealth is a reward for effort. for outsmarting everyone else. But in the market, the exact opposite is true. Like Nick Invests puts it, wealth is the reward for restraint. It is having the almost supernatural discipline to set up something sensible and then be mind-numbingly boring for 30 straight years. Clever is expensive, but boring is free. So I want to leave you with a final thought to really challenge your entire mindset around money and effort. When you look at your own financial habits over the next 30 years, who will you be? Will you be the Danny who works incredibly hard, pays 20 times the fees, and has a fantastic story about how he almost timed the bottom of a crash? Or will you be the Priya who purposefully embraced being lazy, refused to touch her accounts, and accidentally got rich? Thanks for watching this explainer, and we will catch you next time.